Well, good morning, ladies and gentlemen, and sorry for the delay. As you know, markets are rational, orderly, and sometimes predictable. And recently, you remember I've been showing you the long-term charts of the UST bonds and predicted that the next level would be 3 standard deviations below the mean, which I assessed at roughly 136.15, and that's been achieved. In fact, UST bonds has dived through that. They put in their low at 134 from memory. Yeah, 134.30. So it's overshot that, and it's now rallying. I think we might have a decent rally in store. But if and when that market turns down again, then you'll be looking at 4 standard deviations from the mean. And that's quite a mouthful. It's a mouthful to say, and it's going to be a mouthful for bond traders. It's going to be seriously exciting. Okay, let's keep going. If you haven't already, folks, or you have a friend who's interested in trading, please offer them a free 14-day trial of the Danielcode. You simply go to the Danielcode website, www.thedanielcode.com, and sign up for a free trial. If you have any issues at all, and I know that if you've already had a free trial, the website will probably remember you and not allow you in, but contact Terry at support at the Danielcode. He's our IT and membership guru and a very good bloke with it, and he will get you set up. Okay, let's keep going on. So the business of trading futures and Forex is not to be right. The business of trading is making money. I know you might think that those two statements are contradictory because if you're right all the time, you expect to make money. But the reality is that market selection is so important. Make sure, folks, that you're trading markets that have some volatility in them. Markets that are moving up and down. Doesn't matter to us. Forex and futures pays exactly the same going down as it does going up, which is the great charm and appeal of it. But we have some markets are just sensational lately, just been wonderful. But there are a few that have been a bit quiet, a bit stale, consolidating a bit. They're the ones you don't want to be in. And if you're trading the Danielcode, you know what to do, know what you're doing. That's really the only times that you have any real risk. By that, I don't mean you don't have losing trades. We have lots of losing trades. But because the average win is twice or more than the average loss, the Danielcode makes extraordinary amounts of money. And you should learn, folks, to trade time signals. Mike Murphy, who's with us today, says it changed my life. It has changed my life. That's a huge statement. But if you do learn to trade time signals, which you can't learn from the website, you have to do a Danielcode tutorial to learn to trade time signals. The tutorial covers trading price and quite separately trading time. Creating your own signals and trading time is a big deal. You'll be financially independent. You'll be the master of the most powerful trading program I have ever seen. And once you get started and know what you're doing, it's not onerous. Creating and trading DC time signals takes 30 minutes a day. And the way I've designed it all, you don't have to sit there stuck at your computer looking at it. Put your signals on, go away and play some golf or whatever else you want to do. And as long as you're comfortable that your internet connection is good, you don't need to look at it till the next day. Okay, let's think about trend. I've recently been teaching my son, John, how to trade. He's taking an interest in it. And people have a lot of trouble thinking about trend. So I've come up with an analogy, which there may be better ones, I'm sure. But what I've said to him is trend is the greater force moving the market. Think of an ocean beach as a good analogy. Everyone can see the waves breaking as the swells meet the shore, but few can see the major force, the tide. The tide is rising and falling, and the tide, being the dominant trend, does its thing over a period of time. So that's the major force, the trend. and the waves are a periodic smaller trend. The great W.D. Gann maintained that there were always two or more trends in place happening simultaneously. And that's right. But knowing trend with a high degree of probability is the key to successful trading and the core of your stop loss and risk management. You should be spending a lot of time thinking about trend. It's vital. Okay, so here's a chart of the S&P E-mini, and we have pink channels on it. Why do we have pink channels? Well, I guess that's the way the tool came. And my technical skills find it difficult to make any adjustments to that. But you can see we had a nice little trend up there, and then it turned, and lately it's been down with a number of counter trends in between, where you see they've broken out of that channel. And the red triangles that you can now see, they're the counter trends. So you have trend and counter trend, and the counter trends happen within the trend, and then the markets revert to the trend. The strength of the counter trends varies. You can see here we've had a 2-day counter trend, a couple of 3-day counter trends, back to a 2-day counter trend, and then another 3-day counter trend. So one of the most common ideas for stocks traders is they identify a market that's trending. They will measure the first retracement, the first substantial retracement, and that effectively becomes their risk management and their stop loss. And they'll stay in that trend until there's an overbalance of time or an overbalance of price, which is a fancy way of saying you get a bigger rally than you had previously, either in price or in time. And all of this, the vast majority of long-term trading and holding trades for long periods of time is usually, well, the vast majority of it based on stock markets. And stock markets do trend for very, very long periods of time. And they do that because of their own engineering. That is that you may think that you're looking at the same stocks in the S&P 500 or the NASDAQ as you were looking at this time last year, but you're not. Periodically, the stocks that make up these indices are adjusted. And in particular, weaker stocks that trade below a designated number for a designated period of time, they're just out. They're out of the index, and what they're replaced with is a much, much stronger, the new up-and-coming thing usually. So if you keep lopping off the dead wood and bringing in vital new businesses, that is a form of engineering that tends to give you this long slope from the bottom left to the top right. And that's the chart that brokers have used since time immemorial to convince people to buy stocks. And governments have assisted in that because almost all stock market have some very, very generous tax concessions. In America, it's the 401k. In Australia, it's superannuation, what have you. But is this a thing that's suitable for futures trading? Remember, we're talking, or Forex for that matter, remember, we're talking about leveraged markets, and it's the leverage that makes trading of Forex and futures so wonderful and so viable. Losses are easy to get and hard to get over. And there's some really interesting figures posted recently that I saw that don't quote me on this. The memory's not absolutely perfect, but if you lose 25% of your bank, you need to earn 50% on the remaining balance to get it back. I think that's right. If not, the figures are not far off that. It's a substantial loss in your trading bank is a big problem, and that comes to your trade selection. And most importantly, your risk management. Have a look at this. We're talking about overbalancing of time here. You can see that you've had a rally of 2 days, then another 2 days, then 2, possibly 3 days, then 3 days. So, and this is a very, very simple example I'm showing you. This is like Enid Blyton's Trading for Beginners, pages 1 to 3. This is a really simple chart, and you can see there are enough nasties hanging off it that you might not be so joyous thinking about trading the long pull, and that's a little more expression, the long pull, meaning you stay in the trade a long time. But why would you do that? Well, the idea is that you can identify a trend for some external reason, and as long as that external reason is there, it's worthwhile to hold the market. Don't think that really applies to Forex and futures trading, but I know a lot of you are interested in this, so I wanted to examine it for you. Trend lines are an interesting tool. They mark the speed of the market. And if that speed is accelerating, that's a good thing. If that speed is slowing down, you'll be looking for a reversal. And once you put your trend lines on, you can duplicate them. So you don't have to be parallel to the lows to draw an encasing trend line at the highs. In fact, you'll see from the next slide that what we've done here, it's extraordinary how symmetrical they are, at least on this piece of chart. But here we're not measuring from the low, we're measuring from the mean. And mean to the high line is not the same as mean to the low line. They're different, and the market has created them. The market dictates where those lines go. But it's amazing how symmetrical it's been in what a whole lot of folks are finding a very difficult market. This is S&P, of course. But I noticed that our options friends are pulling their hair out with the S&P, which is their major market, of course, to the extent that they say, oh, it's dreadful. Our writers are selling low and buying high. And if you're at all interested in options, or even if you're not interested in options, and I'm certainly not, just to read the amount of research, assumptions, gazing at chicken gizzards is what I call it. It's absolutely incredible in an effort to try and find a trend. Whereas if you're trading Forex or futures, you should know what the trend is with a high degree of probability from the last completed bar that is not an inside bar. And we do that all the time, all week. That's what we're doing. In fact, you might wonder what I do in my spare time. Well, I'm going to show you as we move through here. So let's have a look at the currency market. This is the Aussie dollar. Now, those of you who are interested in trading Forex or currency futures, you need to be aware, and I'm sure you already are, that as a result of the PFG, Peregrine Financial Group bankruptcy some number of years ago now, the bankruptcy court in the States held that, in Chicago, I think it was, held that Forex is not a security within the meaning of the United States Securities Act. Therefore, those people who had Forex accounts had no protection. If you had a futures account, eventually you got the vast majority of your money back from these failed brokers. The trustee in bankruptcy eventually got around to suing the banks and got judgments for negligence against them. And people who had futures accounts, I won't say they were made whole, but they got almost all their money back over a really long period of time. If you happen to have a Forex account after that particular judgment, it's not a security in the United States. So if you had a Forex account, you got nothing. You were just a general unsecured creditor. So what that led to was regulators in the States finally decided we better have a look at this Forex trading caper. And what had been going on in Forex is basically anyone could set up a Forex platform. The vast majority of them were taking the opposite side of the trades to you and relying on the spread, the difference between the bid and the ask, to give them their profit margin. There was one notorious firm, I can't recall their name now, I should. They're a British firm in Forex, and they were doing the usual, all the ads in the world sponsoring Omega watches and polo matches and yacht racing after the high wealth individual. And what they were doing is they were doing just what I told you, but they actually they had two books. They had an A book and a B book. If you were new to Forex trading, they figured you couldn't win with the spreads they had. They put you in the A book. If you knew what you were doing, they put you in the B book, which they laid off with their financial partners in the banking, supporting banks. And what happened on a particularly memorable day, now many years ago, is we had a short in the chief, the Swiss franc. And it was pegged at that time. It was pegged, from memory, it was $1 or $1.22 to the US dollar. Anyway, we had this sell, and down it went. I was trading a lot of positions at those days, many more and much bigger than I am now. But I saw it diving down. I thought, oh, well, it'll pull up at the peg, which I think was $1.22. The Reserve Bank in Switzerland will support it, as they had been doing for years and years, and they couldn't, and the peg broke, and that trade was worth about $32,000 per one Forex contract. And next day, this particular very big Forex trading platform, they couldn't open their doors. And they were big. I think they boasted of having 300-odd offices around the world. They couldn't open their doors. So that, combined with the PFG debacle, got regulators in the States interested in looking at the Forex companies that were operating in the States. And basically they started off by bringing in some long-needed liquidity and capital requirements. But what finished happening, for example, Gain Capital, who had a very, very good Forex trading platform in the States, they got the stage, they said, it's not worth being in this business. Our capital requirements are so big that it's simply not worth it, and they sold that business to an Australian company. Now you're flat out finding a broker in the States who even knows what Forex is, and they certainly don't want to know anything about it. So it's interesting. And the switchover in large part has been to go to currency markets, and the CME has been pushing forward with currency futures for a long time now. And the volume on the majors, the currency futures, the CME, the majors, which are all USD-centric, whatever they've got on one side, they've got the USD on the other. The volume in those is very substantial. In some of them, like the euro, it's huge. So that's become very popular. The problem is that they're all correlated. If they've got the USD on one side, they're correlated directionally. If the dollar goes up, those futures will go down. If the dollar goes down, those futures will go up. So essentially, you're trading the same market directionally. The other currency products which are more akin to some of the Forex pairs, they've got real volume problems. So if you're interested in currency futures, and the trading in them is very, very good, you can just follow the Danielcode trade signals from the Forex signals, find the true highs and lows in your currency market, add 2 ticks above the true high. If it's a buy, take 2 ticks away from the true low if it's a sell. And directionally, they work exactly the same as the Forex markets do. But do beware of volume. Have a look through on the CME sheets to make sure there's sufficient volume if you're trading currency futures. And I say that the majors, with the US dollar on the other side, there's massive volume, plenty of it. But if you want to get into something a little bit more exotic, it's pretty limited. In some cases, it's hopeless. So here's the Aussie dollar, which immediately raises an interesting question. Why is it so correlated with S&P mini? I mean, in this recent period, which I'm showing you here, which is 2022 from about March onwards, it's very, very highly correlated with the E-mini. And why would that be? I mean, here you've changed now. I'm showing you the two together. This is the Aussie dollar in the top pane, and the S&P. It's the index on the bottom pane. I'll show you one with the futures contract shortly. They're very much the same. But you can see that the Aussie dollar has matched the S&P to a very, very high degree. The S&P signals are coming a bit earlier, but the correlations are huge. Why would that be? I mean, is all this Australian superannuation money finding its way into the S&P mini? And as it goes down, are they repatriating? I don't know. I've heard nothing about it, but it's interesting. So let's have a look at your long-term trading in the Aussie dollar. So you can see I've defined the major trends in here for you, just with a couple of trend lines. When it gets big runs with lots of activity in it, it's pretty good. When it doesn't, it's pretty bad. And just look at the risk. We're talking about trading futures here. Have a look at the risk you're taking. I mean, in this market here, the average true range over a 29-day period, just as an example, is $780. And have a look at what your various counter trends are running at. 1,500, 2,600, 2,500, 2,100. In other words, about 300% of ATR. Now, I stress to you constantly that you should never have risk of more than 1 ATR. At most, in my view, 1.5 ATR. So whenever you have an order, an entry for a new position that is bigger in dollar value than that, use 1 ATR as a fixed dollar stop. If you feel brave, use 1.5 ATR as a fixed dollar stop, but never go beyond that. And there's a real reason for that. And the reason is that this marvelous program, the Danielcode, it makes its money progressively over a period of time. It doesn't have a particularly good win rate. The win rate for Danielcode across all markets is 55 to 62.5%. Not fantastic, is it? Well, I can give you a program with a 92% win rate. Problem is it doesn't make any money. One, because it becomes so obvious. And two, because the filters on it are so draconian, you get very, very few trades. And our business is making money. And what does make money with the Danielcode is because the average win is twice or more the average loss. So if you let that sink in and think about it, you actually only need a 25% win rate to break even. And we historically have a 55 to 62.5% win rate. That's why it makes the big money. So this sort of trading, the long pull, can you do that in futures and Forex? Well, I couldn't. I mean, I'm absolutely allergic to all losses. I hate it. And those of you who've done Danielcode tutorials will know that we've got the risk management on our time trading pretty well down pat and under control, and it's not big. But I couldn't even face this. The idea of 300 or 3 times ATR as your, or thereabouts as your protective stop. Not for me, folks. If you want to do it, great. But remember, the actual signals that start off a counter trend exactly the same signals that start off a whole new blown trend. So when you think your trend is, your counter trend's reversed and going back with the trend, that's great. But if you get a counter trend that's a bit more than the counter trend, you're just going to get whacked. And with the leverage in futures and Forex, and given that private traders do not have unlimited funds to trade with, you've got to harvest what you've got. You've got to look after it and protect what you've got. And taking big risks, and in my view, anything over 1.5 times ATR is a big risk. That's for me at least. It just, I don't even want to know about it. That would do more than ruin my breakfast. So pros and cons. The big pull gets big runs occasionally. Equities are more prone to Fed-induced directional bias. Lazy way of trading, but that's been history. You've had this massive Fed support, historic all-time growth in liquidity. The Fed's just been printing it like there's no tomorrow. And not just the Fed. This has been happening in all the Western countries as well. In this country, we're looking at deficits, and we haven't even started to dream of until we got into COVID and decided that modern monetary theory as practiced in Japan is the way to go. Just keep spending. But I'm sure there's always a reckoning, and I think we're facing that reckoning in the not too distant future. These markets actually go where I expect them to go. So what's the other side of the equation? Well, you're taking, excuse me, the hay fever struck. You're taking magnified risk way outside your normal parameters. You're having late entries because you've got to let a fair bit of the market run until you can even start to get your trend lines on there and say, I think this is going to be a trending market. And because your money's locked up for these long periods of time, you have very, very low turnover in your bank. So one of the beauties of trading daily bars, which in some cases can be locked in for 7, 8, 9, 10, 11 days, no more, is that you get to turn over that bank. You get to turn it over many, many times. And the more times you turn over your bank, effectively, the more capital you're allocating. So get rid of that and only have, one trade a month or so. That just absolutely ruins your turnover records. My personal view is that you're just guessing. I know that with bonds and with some commodities, the decision makers decide that they've seen something that economically will continue that force, and they bet on it, and they bet on it in a big way. And as you've seen lately, with markets are now happily going in both directions periodically, including equities, a lot of them are hitting the wall. You can see that. Just have a look at what's happening with the S&P, which is barely, in my view, started its correction at all. And it's wiped out 18 months of gains with a tiny little, almost inconsequential correction. Let's have a look. And then I told you in June last year that I had calculated what I call household inflation at 14%. And we'd heard nothing about inflation for years and years. And the very next day, there were at least 5 inflation stories in prominent newspapers and websites that I read. And I'd love to say they all copied what I'd said, but obviously that's not so. But I was aware of it and told you about it in the middle of last year. Look what's happening now. Walmart, Cisco, another big one, finding that their costs are getting out of control. The consumer is tapped out enough that you can't pass on these cost increases to them. And some balance sheets of very, very prominent corporations have been taking a real hit. That's what the news has been about this last week. So now we can see what a curse inflation is. If you haven't noticed it in your household spending, I'd be amazed. I mean, this is not just an American phenomenon. This is a worldwide phenomenon, at least the Western world. And It's just too much money chasing too few goods and services. That's the definition of inflation. And it's a direct result of US spending policies and others as well, other countries as well. Australia is one of them. But, to see what's going on in the US Congress, with the still wanting to pass another 44 billion, is it, for the Build Back Better. I mean, it's like the money's no object. Just roll it out. And this week, of all people, they managed to reinter Greenspan from wherever he's been hiding. You remember him as the Fed governor at the 2000.com crash and the 2017 housing crash. They rolled him out to explain why the Fed was so far behind the ball. And, of course, they blame COVID. They say that it's corrupted the data they're getting. Blind Freddie could see what was happening on inflation. You didn't need a house full of qualified economists to tell you that it was a problem. And the US Fed is just determinedly, and I mean determinedly, ignoring it. They're paying lip service to it. A 0.25% here, a 0.5% there. That's not going to knock off the appetite for money. That's not going to cure inflation. Those of you who have lived long enough will remember a previous Fed governor whacking interest rates to 20% overnight to kill off persistent inflation. And if the Fed doesn't get a handle on this inflation really, really soon, it's going to become embedded again. And boy, it's hard to move. It's a shocker. Okay, now we're going to talk, folks, about correlations, and they are so wonderful. I want to make sure you understand all of this. So gold, silver, and the Huey incidentally is an index. You can't trade futures on it. You can trade options on it. But gold, silver, and Huey are so highly correlated directionally that a DC trade signal in any one of them can be executed in any other of them, provided the trade is elected. All Forex having the same symbol on either side is correlated directionally. All DC trade signals in correlated pairs of currencies can be executed in any of its correlated markets, providing the trade is elected. And US equities and Germany's DAX, you might wonder why I keep creating the charts for Germany's DAX and the signals, because very few of you actually trade it. But it's vital because it's an outlier, but it is highly, highly correlated directionally with the US equities. In fact, US equities and Germany's DAX are so highly correlated directionally that a DC trade signal in any of them may be executed in any other of them, provided the trade is elected. And I'm going to show you a pretty stunning example of that. Now, right now, folks, equities are moving both ways. The huge, ever-going bull market is over. It ended at the beginning of this year. So it's more important than ever for you to be a competent trader. And for your trading, there is trading, which a lot of you know about, but it's not Danielcode trading. And Danielcode trading is worlds apart from any other form of trading that you may know. And the corrections in equities are at best modest, and I'm going to show you that. And inside that matrix, we can track which swings are being corrected from their retracement, which I'm going to show you. But do let that sink in, that there is trading and then there is Danielcode trading, and they're entirely different. Danielcode trading of time signals, creation and trading of time signals, is out of this world. Or as Murph said, it changed my life, and you can change your life as well. Okay, so incidentally, while we're on that subject, I have 2 spaces available for tutorials next month. If you'd like to do a Danielcode tutorial, you can get started very quickly. I have spaces for 2 more in the month of June. Email me, janeedham@thedanielcode.com. I'll be happy to send you some literature on it, set out what it is, what it does, etc. Okay, moving on. This is the S&P index, and on it we've put our standard Danielcode retracement. Now, Gig, this will interest your friend, who said that we put on too many lines. Actually, whenever we start a new trend, we put on the Danielcode retracements, which are within the operating trend. And there are 6 of those, it might be 7, 29, 37, 44, 50, 59, 54, 89. There's 7 of them with one alternate. And that's all there is. And they are incredibly accurate. They are so accurate that we can actually use them to determine which trend the market is correcting. And as you can see here, the market is correcting a relatively minor trend. But keep looking at that 2020 crash low, the only decent pullback we've had in recent years. I think it's my belief that the market has got to, as a minimum, start correcting that range, which it's not doing yet. And we're not going to see a low. People are already getting excited about where's the low, where's the low. We're not going to see a significant low, in my view, until at least part of that major range starts getting corrected. But remember, all of this takes time. Corrections take a long time. And in equities in particular, the equities market is like a giant oil tanker. It gets direction and momentum. It takes a long time to turn. And that's why this high, which we had forecast was going to come in June last year, waited until January before it finally finished its major bull run. Okay, so this is the DAX index, and as I say, you might wonder why I persevere with these charts, particularly because so few of you actually trade the DAX. But it is highly correlated with US equities, and as you can see here, it's actually been leading the action from US equities in the last 10 days or so. Pretty clever. It got its TO3 and blue line buy signal a day before you got a little rally in the S&P. Its top, clear-cut, easy TO3 sell signal was a TO3 plus sell signal. And that's what's pushed that market down. Now, if you knew about that, you had a very good idea of what correlations are going to do. This is the S&P E-mini, and you can see it had its normal TO3 buy signal at the lows. It didn't create its own sell signal at the highs, and you can see it failed to get anywhere near that 4100 number, which is what we would have expected. But we did have a correlated TO3 sell signal right at the high, correlated with the DAX. And as you've been told, as I've been saying to you over the years, these correlations are so high directionally that a buy or a sell signal from the Danielcode in one can be executed in any other. So if you saw that TO3 sell signal in the DAX, which I hope you did, you could have executed it for a very worthwhile trade in the S&P, or the DAX, or the NASDAQ, or the Dow. This, in fact, is the NASDAQ here. You can see same thing. TO3 buy signal at its low, rally up, didn't create its own sell signal at the high, but it did have a correlated sell signal, and it was quite valid to execute the DAX sell signal in NASDAQ. And it was a decent move down. Interesting, really interesting, the way the S&P has held just above its recent low, 1 point from memory above its recent low. NASDAQ's done the same thing. Are these markets so controlled that the whole of the trading universe doesn't want to take out that low? It certainly looks like it, doesn't it? And let me see what I'm talking about here. I know, but you may not. I'm talking about the low on previous low, which was May the 12th. In the S&P E-mini, that low is 3855. Today's low in the E-mini, 3856. Hard to believe, isn't it? How neat that is. But there you are. Markets do their thing. and the Danielcode will keep you always on the right side of the trades. Okay, so to make that clearer to you, this is the DAX on the top panel and the S&P futures contract on the bottom. So you can see what I'm talking about. It had its own, S&P had its own buy signal, but it got its correlated sell signal from the DAX, which had a TO3 sell signal right at that high 2 days ago. Could have executed that in S&P or NASDAQ or Dow, even in the Russell 2000, which had the smallest move down of all of them. This is the DAX and the S&P as well. You've just seen that. I've just shown you a bit more detail of it. Same thing happens in Forex, correlations in Forex. This is Canadian dollar, the famous loonie, against the Swiss franc. TO3 and blue line signal at the high near 78.08. Easy trade, 3 days down, $1,500 per one contract. Here's the CAD JPY. Correlated sell signal. Didn't create its own sell signal that I saw. I knew it was a correlated sell signal, and you should be looking for those correlations. Strangely enough, taken over a period of time, the correlated signals are usually more profitable than the market which has created the signal itself. I don't know why that is, except that fewer people are aware of it. But you should be going through all of these Danielcode trade signals. Make sure you're looking at the correlations. This is what happened in the Euro USD pair, TO3 plus buy, straight up to the first black line. Amazing stuff, isn't it? You wonder what I do with myself all week? Well, my wife said, what do you do in your spare time? I look at markets. I obsess about markets. Here's the same thing I was just showing you. That was the actual buy signal. Here's your correlated buy signal. Nothing super, but boy, it was nice enough. Correlated signal. This is a TO3 sell signal in the British pound and the Swiss franc. $2,100 straight down, easy. And this, of course, very importantly, this is the US dollar index. And you could take that sell off. We've had 1, 2, 3, 4, 5 days down in the US dollar index, and you can look at that. It gets all your Forex pairs that have the US dollar on one side for correlated trades. So the US dollar index is not just the US dollar. It's the US dollar against a basket of other currencies. I think there's about 20 odd of them. But directionally, the way it's weighted, it's very striking. So knowing there was a TO3 plus sell signal at the blue line at 106, 105 that was elected. I think it's 105, 105. Worth knowing, because that should have biased you as to what was happening in the Forex pairs. This is gold, which has been pretty sticky, hasn't it? You've had a correlated buy signal for today, which is paying off well. But as I told you the last webinar, silver has been a much better market to look at for your signals. And silver and gold are so highly correlated that a Danielcode signal in one can be executed in any other. In other words, if there's a signal for gold, you can execute it in silver. If there's a signal for silver or the Huey, you can execute it in gold. Same thing. Correlations, you should be aware of them and be looking at the correlations. This is silver. It's been a couple of nice little trades there. It gave us a nice $6,000 trade straight down. That was great. That was a TO3 plus sell. Right at the bottom where it should have, at 204, 250, you got your TO3 buy signal. That gave us 2 days up. 1 bar counter trend, which gave us another TO3 buy signal to get long again today as this market's accelerated the upside. This is beans, folks. So the reason I'm showing you this stuff is to try and get you to think past S&P and gold. The vast majority of people that come to me, they trade S&P, mini S&P and or gold. That's what they want to trade. You shouldn't be thinking that way. I know that the whole media is so biased towards the S&P or the NASDAQ, any of the US equities, and or gold, that you finish up getting brainwashed as if that's the only market. And they're not. And at various times, they're very good markets, and at other times, they're not very good markets. And sitting out there, you've got this whole range of other markets. You've got interest rates with the UST T-bonds. You've got metals with gold, silver, and copper. These are the markets that the Danielcode covers. You've got grains, wheat, which has been fantastic, and of course beans, which you're looking at now. Easy $4,000 trades straight up. And then there's soft. Coffee is a perennially good trading market. Sugar, we've had a really good few days trading in sugar. And there are all these alternatives. Just run through the Danielcode website. You'll see them all. And it's so important that you're aware of them, because this market is just screaming at us with these marvelous opportunities. And I fear that the vast majority of you have not felt comfortable diversifying across to them. Which is why I've been talking this week about diversifying your trading. Look at these wonderful markets and what they're giving us. They're just great trading opportunities. Okay, so finally, I think this is UST bonds. Just been perfect, hasn't it? Have a look at TO3 and blue line buy signal right at the low. Success and a time signal at the first high. It came to at 141.06. The blue red line was 141.04. Down 3 days into a TO3 buy signal, up 2 days. Nice big rally today, which faded off very noticeably at the close, didn't it? It really ran away from that high at the close. There's your trading interest rate. At the moment, UST bonds is a very good trading market. And I really do suggest you look at some of these other markets that I'm showing you because they're so important. Here's wheat. I don't know if some of our famous wheat traders from Canada are with us. Let me have a look. I don't think I can see them. I might. There's a lot of people here. Just stand by. Dave's with us. Gig Shade. No, I don't think the guy I was looking for is here with us. But these are wheat traders, a Danielcode tutorial guy. In fact, he's done 2 Danielcode tutorials. And he's the chap who told us last year that he doubled his account in August. He made 600% prior to that on his sides of his account. He doubled it in August, and he got 80% in September last year. And in October, he stopped telling me what he was doing with his trading because he said he's a very good Christian man. He said, it sounds boastful. I don't want to say any more about it. And that's the sort of money you can make with Danielcode trading when markets get volatile. And now a whole lot of his money's been made on wheat. Here it is again. A little $1,000 up, 1 day counter trend, $5,000 into the next sell, TO3 sell right at the high, $460 into today's low. It's just money, isn't it? Money, money, money. If you seriously want to make a lot of money, Danielcode tutorial is the way to go. Okay, it is unlike anything you have heard of, thought of, or seen. It is entirely unique, the Danielcode trading tutorial, in particular the part that teaches you to create and trade time signals. Okay, so that's wheat was looking wonderful and a great trade. Danielcode video tutorials. More than ever now that the markets are going both ways, particularly the equities. There's big money in equities, and we've been grabbing it all. But happy to teach you Danielcode trading. So I say there's trading, and then there's Danielcode trading. If you think you know something about trading, you'll be a much better trader if you do a Danielcode tutorial. If you know nothing at all about trading, even better. And then I don't have to get you out of bad habits. Some of our very best traders came to me saying, I've never seen a financial chart, but I'd like you to teach me. So just a reminder, if you haven't already, folks, do sign up for the obligation-free 12-day trial and learn to trade the Danielcode. There's a massive amount of articles at the website. More recently, there are massive numbers of these webinars that we do twice a month. Learn to trade the Danielcode. It's different to any trade system you may have seen. Members charts, I don't do them for the fun of it. I do them for your edification and knowledge. They're precious and deadly. Take time to look at them. And don't be afraid of volatility. Embrace it. Welcome it. Trade it. And if the bars are too big, if that risk is too much, use the ATR, average true range. Never risk more than 1.5 times the average true range. Even money managers, and we've got a few of them as members, very good members, are now agreeing that Danielcode is more than a hedging option for their stocks, for their portfolios, which traditionally is what money managers have thought futures were worth, part of a hedging strategy. We've got our guys now, Greg, who you know is one of them, the other Greg from Texas is the other one of them. And there's another guy as well from Chicago. They're all saying the same thing. The Danielcode is more than a hedging option for their stocks portfolio. It is a wealth creator. I've been arguing that for the last 25 years. And now I've got some seriously good traders and serious money managers saying the same thing. It's worth your time to learn the Danielcode. We are on Facebook, Twitter, and YouTube. More Twitter, I think, than anything else. But there's a ton of stuff on YouTube. Our website is youtube.com/Danielcode. You can see all of the webinars on there. And this, folks, is the disclaimer, which I do urge you to pay attention to. It's really easy to lose money trading if you don't know what you're doing. In the same way, it's really easy to make a lot of money trading once you do know what you're doing. So do, for goodness sakes, don't risk any real money on your trading until you are absolutely convinced that you are a competent trader. Better still, contact me, ask for a Danielcode tutorial. I will be happy to send you the paperwork on it. If you find it's too expensive for you, it's $7,500 US for the whole tutorial to teach you everything there is to know about trading price and trading time. If that's too expensive for you, get started on one of the TO3 or TO3 Plus packages, or the 6S packages. You will find doors are open for you, and I am here to help you in any way I can.